having that skill set of being able to measure volatility will give us an ability to forecast that distribution of volatility and improve our trading. This is the monthly VIX chart, line on close, and you can see that there were 3 high peaks, and otherwise volatility stays between 10 and 20 on average. We'll get a little bit more in depth on how the ranges of volatility impacts trading, but just understanding right now where we are in the VIX is fundamental, really it is, to both directional trading and measuring risk. That's your key takeaway. I hope by the end of the session today that you're going to be inspired to think about the markets structured in standard deviations, and that's what we will learn is the best method for measuring volatility. So let's skip to the next slide real quick and talk about me just a little bit to give you some background. I've been short-term trading now for about 10 years. I stumbled into day trading after being laid off following the great financial crisis #1. Law firms got hit really hard. I come from a legal background. I had the privilege of working with who I think are some of the best attorneys and corporate law firms in Houston and Tampa. So pretty much between 1979 and 2014, I had worked my way up from being a receptionist to becoming a highly skilled and trained litigation and appellate paralegal with 2 advanced certifications in electronic discovery. So the biggest bonus for me of leaving the law firms and then, integrating myself into day trading is I was able to use that 80-hour-a-week pattern and keep going, right? No, I'm just kidding. The best thing about trading is not keeping that 80-hour-a-week pattern and being able to dial it back to just a couple of hours in the morning. I mean, that's what the whole attraction is. And so that's what I've been building for, is just come to my screens for 1 or 2 hours in the morning, grab some money and go home, have the rest of your day in your life. And that's really ideal. And that's what I strive for. So I'm a part-time in the morning trader, and that's all I want to look at is just right after that market opens, trade the high drive, and just get out, because that's where I have found my sweet spot is the best. And so learning about the markets, learning how, for instance, volatility and that standard deviation structure really works and how the algos are tied to it, that's what we're all going to learn today. So I hope to teach you about what I have been checking out, and hope that you find that this works out for you also. So let's get started. This is the VIX. Again, this is a line on close chart of the daily VIX. I drew a halfback for reference of where we are, of the thrust we had following the pandemic in March and April, and has price came back to that halfback, it just kept falling, and we're moving back towards our base of where we were. We got a little bit of an uptick yesterday. I did not see the market this morning, but yesterday we had an uptick in volatility, and which is great for day traders. I mean, I hope y'all had a good trading session yesterday. When the volatility comes into the market, that's where we shine. That's where we can get the extra juice that we want, go for those outer, targets. If the volatility is falling, then we just, scalp around, hit the pivot point or the, R1, something that's close to trade to. But just understanding where we are on volatility just helps trading so much. And that's really what we're going to be talking about. So our agenda for today is about volatility in the VIX, and really incorporating that in and using the empirical rule, which is the standard deviation of method for harnessing volatility. I think you'll like it. So again, not anything real technical. Don't stress out. There's not going to be convexity. We're not going to be talking about the term structure of the VIX or anything like that. Just very down and dirty, simple tools that you might appreciate knowing about by the end of this session. We'll talk about how these historical ranges can be encompassed with these ranges using the JATS-PT indicator, and also using implied volatility levels and open interest. That'll be fun. And also using the market analyzer, which NinjaTrader gives to us, to be able to track volatility, which is awesome. Also, Bloodhound has a bar link solver giving you ATR that I think that you should be incorporating with any of your solvers, and I'll show you how I use it when I create my solvers. And then, of course, we've got some special offers, so stick around to the end if you are thinking about getting NinjaTrader or Bloodhound for the first time. Again, Keith gave you a few of the disclaimers, but again, this is a webinar for educational purposes and not a solicitation for you to go out and buy or sell the VIX index, or the ES or the NQ. Past performance is not indicative of future results. And as the second slide tells us, that is because we don't know what the volatility is going to be like the next day. Nothing that happened yesterday could repeat consistently tomorrow. So you have to just be on your game and understand that there are limitations of using hypothetical performance results or looking at past charts to come up with future trading prognostications or forecasts. But with that said, there are some things that we can do to help us frame volatility. When you think about volatility indicators, you've got the Bollinger Bands is a good one. You've got ATR and the VIX. So really what you're trying to do is just get a structure for volatility, which is mean reverting. That's your other takeaway from this. Volatility will revert to the mean and then either return in the direction that it was going or reverse at that location. So we'll talk more about this mean reverting aspect in just a little bit, but I wanted to show you that just getting a Bollinger Band, a standard 14-period Bollinger Band around the VIX, is an awesome indicator. It's a good default setting, just like it is for the ATR, RSI, stochastic, Stonkian. The algos just love that 14 period on a higher time frame. So if you aren't measuring peaks and troughs, that is another way to measure volatility, taking that middle point and using volatility to see if I'm low vol or high vol environment, and do I have a path for volatility? Where's it going? Is it going to break above that mid band and make a run for it? If you see that volatility is breaking out of your mid-band, that's maybe, jump in there, put some extra position on and be going for those outside targets. Or if you're low volatility, you want to be fading those extreme moves, right? You want to be fading those highs or conversely, those lows. Here is my JATS indicator. We'll talk about this more in depth today. It coincides with the principles of the bell curves and standard deviations. But to give you a down and dirty overview of this, Adrian with Expert Trading Programmers coded it for me, and that kid is a genius. When I first talked to him about, what I wanted to do with plotting statistical percentages of a given range parameter that I can have my customers customize to their own period or time frame, he was like, well, getting a square root of the variance for standard deviation, it's going to kind of be tricky for me, Miss Wade. And I'm like, wait a minute, Adrian, let's just use the empirical rule. Trading is like horseshoes, close is close enough. And so he helped me put this indicator together to show the principles of these significantly statistical levels using the empirical rule that we'll talk about. And it worked out pretty good, if you ask me. But we're going to definitely learn more about the bell curve and using standard deviations in a few slides. But for right now, I just wanted to show you that the bell curve is probably the best method to measure volatility that I have found, as it smooths volatility out and gives us that standard deviation metric that we can use to see where we are in the range. This is that June 11th peak, and this is the monthly PT indicator, and you see price got to that monthly level and turned back around. Using the Donchian channel with the JATS PT is also very, demonstrative. You can see price traded inside that first standard deviation. The white lines inside the white represents that 68%. And option traders are paid if price closes inside that first standard deviation. So they're all getting their paychecks. This is what they want. And when price goes outside that area, that's your fat tail. And obviously we got, a big move outside of that during the pandemic. But ordinarily what we're looking for is a reversal to go back to the mean or to the distribution, and then here was that trend continuation back down. But otherwise, when you get out to the outer bounds, it's going to turn back around and come back to the middle because volatility is mean reverting. So if anything that you learned today from this session is, if you don't get my indicator, which is fine, get the Bollinger Band on your VIX and be sure that you set an alert in NinjaTrader, because when it starts hitting that mid band, that's going to give you a big tell that something is going to change. It's either going to give you an opportunity to buy some vol, and go for those outer areas, or reverse back to the mean. So here we hit yesterday back to that mid band and it stopped. So I have not seen the market this morning. I think we were up a little bit, but so that volatility probably turned back around at that mean spot. This is probably what you're used to seeing when you think about vol, and that's overlaying the VIX with the ES. And when the VIX goes down, that ES goes back up. That is that opposite correlation that's inherent with volatility in the equity indexes. It's very, very easy to see and to trade and to get that concept. But otherwise, you want to know where you are relatively on highs and lows of the VIX. So what most technicians will tell you is to take those extremes and go to the middle of your two extremes to get that midpoint, so that you can get a more accurate depiction of where you are for a low vol or a high vol environment. So whether you use that, just, grab your Fibonacci tool and put a half back on the high and low to see where you are with that mid band. And that's what I did at the beginning to show that we were just under 50 with our high-low watermark because of that huge 6 sigma event, which is a very high volatility. So if we do break above that Bollinger Band, mid-band, or Donchian, I'm sorry, Donchian mid-band, we're going to have a very good time trading. Because I love momentum. I'm a momentum trading girl. I don't like that low drift. And so I'm not sure what the hell I'm doing trading equity indexes, because mainly it's low drift. But at least we know what we're looking at. Part 2 of this indicator is the PT2, and that tells me whether the range is expanding or contracting. And I can set these range expansions with a short position very easily and spot those high volatility times. Otherwise, it's just low drift. and you're trading in that low drift, that doesn't mean that you won't get a down day, but pretty much buy the dip in the low drift. And this is a liquidation event, obviously. There's nothing you can do when people start closing their accounts. That's just, it's going to happen. The institutions normally will hold through a down dip. They did not do that in March. They held on for a while, and then even the institutions started selling off, and that caused that second leg. So when everybody closes their accounts, that's why you got that Six Sigma. You just need to get out of the market. It's way too expensive. I know that I tried to go in there a couple of times and I got my ass handed to me, let me tell you. So I just got to be careful. This is the VIX daily chart with the weekly JETS PT indicator. So this PT indicator can be structured so that it's on weekly, daily, RTH session, or the 1 hour initial balance, just that first hour of trading. We can do a 14 period on that, and I'll show you what that looks like. It's really cool, which is how I use it for day trading. But again, you can see that the option traders are paid to have that closing price inside that first deviation. So you know everything is running smoothly when you see that. So the VIX term structure here was very smooth. You got a little spike up. That was that June spike up. And again, that was like a 13% drop, I think, that one day in the ES. So they came up right to the weekly PT3 and turned right back around. So wouldn't you like to know at $50 a tick where these, peaks and troughs are? That's pretty cool, isn't it? Just think about that for a second. So I've got a weekly chart on the candlestick to show you that comparison. This is with the proper method of what people usually do, is measuring the peaks and troughs to get you your halfbacks. And so I measured that June peak and with a couple of others to get a couple of lower. So you see our halfbacks are also falling, giving us that overall downward path back to 20 in that low vol. But I'm, hoping to jump on volatility each time it crosses above my one deviation so that I can, at least know that where to trade to on this higher levels. Here is a 30-minute chart using the VIX on a daily PT settings. And again, you see inside the first standard deviation, everything was copacetic. All the algos are running smoothly, and then we had that breakout. So this is where, momentum traders, like to get involved in the market. And then conversely, knowing that that's a good spot to turn it around if you are in a term structure for your VIX, moving back down, that's like a great spot to pick out. That's very timely. I think that was August 11th. Yeah, that was yesterday. And this is what it looks like with Bloodhound, same 30-minute chart with candlesticks, just being able to put a sell order in any time you get a close above the first deviation, the upper DV1. And I put in Bloodhound a extension, signal extender on it so that I got the next down bar coming back down. That way it helps keep you out of false moves. So like this, I got no down signals because we did not get a down close. So, so that's why I didn't have a down close on this bar closing above it, is because it was an up bar. You want to wait for a down bar. Always wait for your momentum. That's one thing. If there's another thing that I can teach you in trading, it's best always to wait, because you never know when this is going to turn around and go up instead of back down. So always wait for your bar. And then again, conversely, VIX trades opposite the ES. So as the VIX was going short, that's when you want to come in and buy the bottom one on your ES contract to get that long swing trade, right? So you can see how that VIX just correlates naturally with my PT indicator. And timing these entries. And again, the goal is those coast to coasts. You know, obviously I would prefer getting in at the very bottom and going to the very top, that coast to coast, but just getting in here and traveling to the top is an excellent trade. You know, capturing that first standard deviation or trying to go to the 2 or 3. And which brings us to, you know, really trying to understand what is this bell curve all about. It is just a statistical concept. I'm sure many of you are familiar with it. The first standard deviation is represented by 68% of the middle of the data distribution, with your mean right here in the middle. The Greek letter sigma represents the standard deviation signal. And so what I would, you know, do is trade off the open, and that's how I had Adrian set my indicator, is I could set the opening time frame, so that 8:30 to 9:30 a.m., that first initial hour of trading would give me my mean, and I automatically had my distribution, and I know where to trade to that 1 or the 2. And I was doing this in the trade room with an Excel spreadsheet. And I was drawing my lines manually on the chart and seeing if I could, you know, trade off the open to the 1 or the 2, and how often, you know, if I could get the direction right, would it make it there within my risk perimeter using the standard deviations. And we were hitting them like all the time, and it was really working. So that's when I, you know, reached out to Zach and said, you know, I've got to get somebody to help me code this because it's like working out really great for me. So thank God for, like I said, Adrian put it together. And I cannot tell you how much I love this concept. Steidelmeyer has been using it for volume profile. And we'll see how he puts it together. But it's just basically using this normal distribution. And he teaches volume profile traders to hit these ends and bring it back to the mean. That's basically all that volume profile does, is you wait for it to get outside the distribution and you send it back in. And here I'm going opposite. I'm going from the middle to the end as a momentum trader with direction and off that open, because it's the highest, you know, volume of the day. So if you can get a directional path, that's what I would like. But more so, if you just recognize if you're opening outside of a, you know, distribution, you have a high chance of breaking a range. And so that's when you get your once a month or twice a month that it usually happens, where we can get that fat tail where we're breaking out of a range going higher or lower. You know where you are because you know that you're outside the range going out. You already know where your distribution is. So just understanding about the normal distribution, y'all can research it. It's all available for you free on the internet. In fact, Steidelmeyer on markets is free. It's on my website. I've got a video of him talking about this in the video section on YouTube that I put on my page. I think it's well worth your time just to check this out. And here is his little mini volume profile curve, and you can see that this is exactly what they do. They wait for those tails on the outside of the distribution and they send it back in. So whether they're trading outside that initial balance or not to the end, you can do it that way. That's the way I do it. Or turn it around and come back in. Sometimes I'll turn it around and come back in, and I've set a method for myself to do that using my linear regression indicators, offsetting the ATR from that main trend line using the same concept. I'm using the bell curve statistical levels in my linear regression indicator. And when it gets outside an ATR, it's basically the same thing. I can come back in at that time. So whether I'm outside the PT indicator or outside of my LRT lines, I know where my outside lines are. And so I do recommend that you look at the bell curve for this methodology and incorporate what other indicator, whether it's mine or just an RSI or a CCI or stochastics or whatever you'd like to do to confirm your overbought oversold settings. I think you'll be very well on your path to making some successful trade opportunities. Here is the volume profile overlaid on my JATS PT indicator, which works out really well. And again, that normal distribution, the 14 period works real well. You can customize it if you want to put this on a smaller time frame. You can use a 20 period or a 50 period or whatever you want as your period. So that is customizable. But here's just the normal. I've got an RTH setting for the volume profile on the right, showing that tail, and price comes back to volume. And that's another thing that Stottlemyre will tell you is price trades to these volume locations. And so you can set this to show points of control that have not been hit, and that's where price will come back to these points of control area and then turn around. And if that coincides, like right here, we had a PT3 with a PT1 at a POC, you should be sitting on that spot like a spider waiting, waiting. And then you get on a 1 minute or 5 minute chart, you can turn it around and bring it back in to where are you going, to volume or the other side. 1 and 2. So it's very simple. As Zach will say, it's 1, 2, and 3. We've got 1, 2, and 3, and then on the other side, you've got 1, 2, and 3. So anything in the middle is just rotational, up and down. If it gets outside, you're trying to get to the 2 or the 3 and or turn it around. Very, very simple, very, very effective and very simple. And here's the NQ. Same thing, again, inside the first standard deviation or outside trade to your 1, 2, and 3. And then turn it around on the ends and then come back in. So it's just a really nice way to measure volatility. Sigma events, this is where we get that max 6 standard deviations away from the mean, and that's very rare. That's what happened in March, and you can measure this just by using a ruler or the horizontal line indicator and put it on the chart. So I put my monthly distribution with the JATS PT daily with a monthly distribution, and I just measured the deviation, and you've got 1, 2, 3, 4, 5, 6. There's your 6 sigma right there outside of that area. So, and then it topped out. So after 6 sigma, I mean, I think that would be like the largest you would want to see during an excursion away from that huge excursion. I think the algos start kicking in and forcing it back down. So this one got back to the middle part and just kept falling. And there's that June pop. But this is just, here's the base of starting out in February. I put a line down here to show you that that's where we started basing back at the beginning. So we're all the way back to where we were on our distribution back in February. And that's where the price started turning around again. So hopefully if I get my, wish, volatility will pick back up, because like I said, I want that momentum. And I would be happy to see momentum, coming back up to that first standard deviation again, and maybe the second or third. because we'll get more juice. We're going to see some screenshots real quick, just overlaid with the indicator. This is how the PT indicator comes. It's PT3 on top and PT2 on bottom. Sorry for these abbreviations, but just think of 1, 2, 3. You've got, the middle part is your first standard deviation, the second and the third. 68% in the first, and then it gets smaller as you go out. And you can see how this just works like beautifully. It's like magic, Standard deviation is one of the best metrics for measuring price volatility that there is. And even using a dumbed down version like we've got, and it still works. I mean, they are statistically significant levels, so that's why it works. And we're spreading it out on a higher time frame. This is a 30-minute chart with the daily or the RTH session, and you can see the same concept, buy low, sell high, and just in the last couple of days. So this is very current concepts. Here's the chart that I normally look at. I'll put the 1 hour initial balance on my chart, and want to be, trading when it's outside that 1 hour initial balance, because I'm going for the 2 and 3 or a break and runner. And that's where you get your event going out. I like the Bollinger Bands on the chart. Also, Donkey and Bollinger, just any volatility. Even my linear regression trend lines indicator is always on my chart too. If you don't have the LRT lines, put the Bollinger Bands on the chart. That's why I've showed it like this. You just want something else as a reference. I have the LRT lines on my chart, but this is the same concept that you'll want to keep. So you can see that you had your trend opportunity, big trend day here, August 4th. Good trade session right there versus that flat chop, knock you out, spit you out, especially if you're dumb like me and just keep trying for it. It just did not move. We were on market highs, so that's very dangerous anytime you're trading market highs and in a low volatility environment. And I'm just an idiot for trying to push it higher instead of waiting for these, pick your spots. Much better right here, August 6th. Get it back up. Much better. So with Bloodhound, it's pretty easy to use. You can get a distribution set up so that when it goes below that 1, you can have it set up to trade. This is a 60-minute distribution on a 1-minute chart. So you can dial it down to the simplest of smallest ranges, and it works really well. So here's a 60-minute range on a 1-minute chart, and showing you how that, fat tail worked, expanding the range to the downside. And then as we have learned in volatility, what, it reverts back to the mean. So you want to be able to trade it back up also. So down or up, and you can set that up extremely easy in Bloodhound. I mean, it just takes a few solver. I like the long short modifiers. They work really well, and then you can just put another one on it too to swap it. So I'll use the long short modifier to do a directional trade that I want on a location, and swap it. Just use the same solver and put a swap on it to bring it back in. Otherwise, on a higher time frame, works really, really well to show the short retracements. Otherwise, you're in the drift. So here is the retracements using the same thing. I use the long short modifiers with my range expansion going short, and otherwise you want to go opposite direction, the drift, for longs. Here was the higher time frame chart, the daily, showing that huge drift, and or a smaller, more manageable 30-minute chart, and just showing that short-term melt up drift that I hate as a momentum trader. I'm just so it just makes no sense that when the range is contracting, the price goes up, but that's how it works. So as you can see here, all of these are range contractions on bar melting up. This is very, very interesting. I just stumbled on this not too long ago. I feel like I'm really late to the party, but implied volatility is like another way to measure these ranges using the standard deviation. And it's something that you should definitely be looking at, especially because the CME website is for free. All you have to do is go over to the CME's website page, and they've got this great tool that will allow us to look at these implied volatility ranges of the standard deviation on their bell curve for the current option pricing. So on the equity indexes, this is for the NQ, you can do a session contract, a monthly contract, or a weekly contract, and see where that open interest is, and see where your put calls are, strikes, and the volume of these put call strikes relative to your standard deviations. So as price approaches these levels in real time, I will have annotated now every morning. I'll come in and note my put calls and my open interest levels, and see if there's like a major level that price is going to be attracted to, because these are really strong price attractors. In fact, I think a company I just saw opened up and is porting this in directly into Bookmap, which I think is very smart. But if they would import it into my indicator, that would even be smarter, right? If they would put that on my PT3 indicator, I would love it. But otherwise, I'm just going in and doing the old write it down on a piece of paper and look at it before the trading session method. And so I'll know my levels. It's like when price hits that 10,940, I'm going to be expecting some action. And that's what I want. As a minimum trader, I want to know if I can get to that first deviation on the implied volatility also. Has been working out really, really well. So this is on the CME website. It's this tool. Email me, I'll send you a link. But definitely put this into your toolbox and be looking at these levels. Here's your 1, 2, 3 up here on top. You can see the 3 standard deviations, and then the second one is the 2, and then here's your 1. So you've got your deviation levels right up here. And again, you can set this by contract, you can set it by month, you can look at the change of volume, you can look at the just open interest or intraday volume. The difference between volume and open interest is open interest is when you go in and maybe put an order in on near a strike using delta or whatever you want, just to have it sitting out there in the open. It's not been filled, and that's the open interest. The volume is where price actually closed, opened and closed, it traded at. So I think open interest is more of a forecasting tool than volume that had already occurred. But you can, maybe get some value out of both. But as far as a forecasting tool, I think it's really, really nice. And definitely check this out. It has helped me, especially in relation when I match this to my PT3 indicator. Let me tell you, it's like bingo. So, and then again, just to recap what I've done, the PT indicator plots the statistical percentages of that range parameter that you can customize. So you can put it on a weekly or a monthly or a daily or an RTH session or that 1 hour initial balance. And I use it with the opening price, and you can also put a different distribution on it with the closing price also, because the algos trade to both. It's like that pivot point. You know, you can put the pivot point on intraday data or data or daily data. You know, the algos are going to hit both of them. So just knowing where it is, but you can customize it yourself and measure your targets and your risk levels using these parameters. I input it into the market analyzer, so I'm sitting there watching it on my monitor. I'll know for that 1 hour initial balance range what I'm expecting on that 14 period. So I'm looking for about 100 points, maybe a little just under 100 points, 96.75. And then I can break it out between my 1, 2, and 3, 33.50, 67, and 93.50. Um, you know, if I can get the full 93.50, I'll stop trading. I don't wait. It's like, in statistics, not every kid is going to be the same height. You're going to have 6 foot, you're going to have 5'5". So don't always try to hit the 6 foot, try to get your average. And this just gives you an opportunity to see what is available in that first hour of trading. So that's very helpful, right? So, just being able to look at it, I break it down. I can go 60-minute, 15-minute, 5-minute, 1 minute. I, break it down as much as you want. Also the full RTH session and the Globex. So just using the NinjaTrader Market Analyzer for these types of functions is very, very helpful. So I'm definitely encouraging you guys to do that yourself so that you know what those ranges are likely to be. And Bloodhound has this great little tool, the bar length tool, and it helps you set your ATR to whatever you want it to be. So if you want that one, ATR or above, a little bit above 1.3 before entering a trade, that confirms that you're going to be entering a trade with momentum. So you're not just hitting every down bar, right? Get in with a little bit of, if you're a momentum trader, I should qualify that as like I am. I always like having ATR on my side, and that gives me that juice, gives me those extra ticks, because that's what I'm looking for, right? I just want those ticks. I'm in, I'm out, got my whatever, and I'm done. I don't want to be sitting there looking at a monitor all day long. So I just trade in the morning, and that's really just a couple of hours, and I'm done. So you can also set this up so that if it shows you I didn't show you a screenshot for this, but you can set it for like 3 ATR, and anything 3 ATR, you can set it so that it would not trade. You can put a swap signal on it, and that way you don't get any 3 ATR trades. It takes them out. It won't even give you that entry, even if it met all of your other filter conditions. You can say anything over maybe a 2.5 ATR, do not put me in, because it's just going to come back around and knock me out. And that's usually what happens when you get those big wide bars. It comes back all the way in. And that's, the converse effect of ATR is you get a move, and then that volatility algo will kick in and go opposite. And so I would sit there when I was beginning trading, and I would see those news events come out in the morning, and it was really good, got a really good employment report or something, and I'd put a position on, and I never could understand why the hell is price coming back against me. I could not understand it. And that's because the algos are tied to that opposite VIX. So you got that push, that volatility push, and the algos kick in to go opposite. So that's why it's so important that if you are a trader to kind of wait for that impulse trade and then maybe get in on that second leg. Wait for your pullback and get in on that second leg and hope that you get the follow through to get to your target. I'll jump in on the first one because I'm mindful of them turning around on you, but you just be aware that it's probably better to sit and wait for that second leg to come down if you're starting out. And that brings us to our packages. We're almost at the end. I have my standard suite of indicators, and just put a sales price on here for you if you are interested to get a bundle, or you can go to the website and get these one at a time without the bundle. But this is a great price, a good savings. One machine ID per license, and this is through August 19th. If you like Bloodhound, if you have not used Bloodhound, I definitely recommend it. I could not have done what I have accomplished without Bloodhound. It's just drag and drop simple. You just put things together on a logic board, and Zach trains you. You can send him questions. He'll have a once a week training session. But definitely, I think worth your investment, especially even if you code. I think it's worth your time because you're not sitting there trying to do 2 days of something that you can do in 2 minutes, literally, for banging out trade ideas. The only thing it doesn't do is that math. Like Adrian was saying, I can't get you the square root of that variance, but I'm like, it's okay. We're just going with the statistically significant levels on that range. So it worked out really good. So here's a Bloodhound bundle, and good time to do that. And I've got a Blackbird bundle also. So if you would like to get Blackbird, definitely would be the time to package this up. Also, very good, if you are not familiar with NinjaTrader, it's a good time to come in and get NinjaTrader also. They're having a special. So before August 31st, if you open a new account with NinjaTrader Brokerage, you can trade micros commission-free in September. So you would need to open an account and purchase a lifetime license. So you would get all of the momentum, the volume profile levels, and the extra deluxe suite of indicators that come with the lifetime license. So that's something to keep in mind. And with that, we're at the end of the webinar. I appreciate it. We'll be looking at some of your questions. If you want to get a hold of me, if you like that CME link, or ask me any questions about things that we've covered, feel free to reach out to me, support@JAuto Trading Strategies. Like me on my Facebook page and Twitter. And thank you, merci beaucoup. Again, thank you, Zach, for having me. And I'll open it up to the questions. And I see that I've got some on both panels here. So let me start with the question and answer pane. Ezra is asking, is it like VWAP but on VIX? No, Ezra, I'm not sure what you were asking about. My apologies. Send me an email. I don't understand your thought on that. You can use VWAP on the VIX also, but the Donchian channel, I'm just trying to, because the VIX is reversion to the mean, I'm trying to get you to think about that the VIX is going to go back to that middle part also. So anything that can give you a middle part, Bollinger Band, Donchian channel, something like that, that would be able to structure that VIX around. Tony's asking, is it a question of whether 1 or 2 standard deviations, you still have to get direction right? Yes, Tony, correct. And That's why I have a market analyzer tool that is my signature tool that shows me direction. I've got higher time frame trend, momentum, and linear regression on my market analyzer. And so I've already got the direction during intraday period. When the direction is right, you'll see that they all light up like a Christmas tree light. They're all red or they're all green. If there's a bunch of zeros in there, that means there's no directional trading. And usually it's when it's in that first standard deviation, you'll see that rotational trade. And that's like in between your, okay, that maybe is what Ezra's saying inside that, yes, in that VWAP in your first deviation, the same principle, correct, Ezra. Now I see where you're going with that. So that's correct. So anytime you're in your profile or your one deviation in the VWAP, it's the same thing. Yes, sir. It sure is. And Tony's saying, bringing up a good point, not all trading days follow a normal distribution. We would all be making money if that was that simple. Well, but have you ever seen it laid out before for you where you have, let me see if I can go back here a few slides to see it's the higher time frame, and get a smaller, here we go. It's the concept of when price comes back into a prior area, you can daisy chain these distributions, which I didn't do a screenshot, I should have, but I can lay a RTH distribution over the 1 hour initial balance distribution. So I'll get more levels to trade to. I'll leave my 1 hour initial balance distribution and go to the RTH distribution level. And then from the RTH distribution level, where the weekly level is. So these can be daisy chained, and it like starts with a 60-minute, and that's the smallest I would use, is a 60-minute. Then the RTH, the 1 hour initial balance, which is different than the 60-minute. The 60-minute goes on a 60-minute bar. The 1 hour initial balance goes from a time period from 8:30 to 9:30 in the morning over 14 periods. And for day trading, it's really, really sweet. So you stay out of that middle first standard deviation. And so you can overlay VWAP or your profile on this so that you could see where those levels interplay with this, but it's the same concept. But once you see that these algos, that this is exactly where they come in over and over and over, like lather, rinse, repeat. Right here's the second one, here's the PT2. You'll get used to where they turn at so that you can have an order then going back up and stay out of this so that you're not getting your head handed to you. Correct. So it is the same concept. It's just organizing it in a different manner, more of a statistical manner than I think that that VWAP or profile give you, but you use them in conjunction with that, and you're just that much further ahead of the game. And not all days are a normal distribution, thank God, because now we can see that the range is expanded, and that's when we want to get, you want to get it participating. So when it leaves that third deviation, that's when you want to start, hitting that buy button, piling on orders and going, getting that extra 10 points on like 5 contracts and like putting it in your bank and saying, thank you so much. Because you know that you're in an extended move, extended markup. I have, Tony's asking, can I tell him what our monthly returns are for the last 6 months using your indicators? I haven't tracked them for the last 6 months. I had 55% positive in July. and we just started August. Had a few rough days in August starting out, and I'm building my way back up. I think I'm like at 10% now, 14% in August, but I was 55% in July, and I think I'm at 15% now. I lost like I did a was testing something else that wasn't working. So, and that's really what I'm doing right now is I'm testing for my algo. So this is all working for me to build an algo around. So I'm not selling a strategy. When I sell my algo, you'll be able to get it on NinjaTrader brokerage or through Collective 2. Is that standard deviation of price or price change? This standard deviation is of range. So it would be of price change, just range. This is not a standard deviation per se. It's not calculating a square root of the variance. I'm just using a down and dirty range using those statistical methods. So it's the same principles. And what surprised me happily was it doesn't really matter that I'm not calculating a square root because I don't think the algos seem to care. I think the algos are all pretty much doing what I'm doing. So I think they all had that first thing that Adrian was like hitting his head on the wall about, and I'm like, well, try this. And it worked. And where do I go with the move and where do I fade it at 1 or 2 standard deviations? And that is a great question. I will, I've got an opening range indicator, which I highly recommend that you adhere to the opening range principles. And so if you have an open and you break, here's my orange line for the open. If you break above the open, it's going to the 1. So here we are down here, it's going to the 1. And see here, it just held at that 1 all day long. So frustrating. Trying to get to the 2, and at the very end of the day it got up to the 2, but usually if it breaks the 1, it's going to hit that 2 right away, especially on this 1 hour initial balance range. So that's exactly what I'm doing. I'm going from that open to the 2 or the 3. So I go from 1, 2, 3. That's exactly what I'm right. Tony, you're right on the money. That's exactly what I'm doing, trading this and using the opening range indicator. So, and then having that opposite end for your measured risk. And you can fade it also. I mean, if you are a fader, like if in that, and that's where I think the volatility comes into play with this so much, and how I'm going to be using volatility in my algo. When I get this working, like ideally, it's all going to be working for me in the morning, and I don't do anything but flick a switch. So my volatility indicator will know whether we're in low vol or high vol, and trade those breakouts or fades accordingly. Yep. Thank you, Robert. Thank you. And hey, Heinz, thank you. Thank you so much. Nice to see you. I appreciate that. I don't have to recenter. Arby's asking, do I recenter? This is just where the open came in my distribution. So the distribution is how it's set up. And again, the way that we did it apparently is how the algos have done it too, is you can just open your eyeballs and see. We don't have to do anything. It just sets itself. And I set it to a higher time frame. I set it to the RTH session or to the 1 hour initial balance session, and I use it off the open. Yep. And I go from the 1, 2, 3 off of that. And thank you, James. I appreciate that. And yes, do send me the email. That CME is just awesome. I don't know if y'all can, let me see if I can drag this over here. I don't know. Can you see that Bing page? Oh, thank you, Raju. I appreciate that. Yeah, just keep thinking reversion to the mean. Can you see the Bing page on the panel? Did that work? I don't know if you can see the Bing page. Oh, you do see it? Okay, good. So over here, I've got it set up. I can pop it right here. It is. It's the CME group. I just popped it into the chat box. So if y'all can go look at the chat box, I just put it a link for you. It's called the ball-to-ball expected range, and you can get more pricing tools over here, but it's just fantastic. So what I do is you go in here and you change it to equity indexes. And from here, you can change from your contract, your current contract, or if you want a different contract, or your, and I do OI total. And it spins, look for this little spinner, and then it comes back up. There we go. And then it gives me all my levels. And as you see, as volatility falls, that's where you get the price rising. And if volatility is rising, these are the locations where you want to be looking at for entries for your targets, and especially around this standard deviation. And you can do it again off the contract, or you can change it to a weekly expiration or an end of the month. And we're here right at Wednesday, and every morning I'll come in and check them. Like right now, we've gotten a lot more open interest at the edge of this weekly expiration. So you can come in and look at these strikes and see how many contracts are out there. And you see that they're all over the place now to the upside and where they are. And it's so helpful to know where these are at. Of course, your big even numbers, you're always going to get something there. But here was a big one at 10,900. Look how huge that is. Huge. So definitely put your eye on this. I think it's very helpful. There's one called end of the month. I haven't really paid too much attention to that because I just stay on the weeklies or the expiration contract. But same concept for what's left for the end of the month. So you can see all of your calls and then all of your puts and calls and how they stack them. So definitely check this out. This is the ball-to-ball expected range. And again, you've got other fantastic tools up here. So definitely check it out. It's CME group. It's here. It's available for us, and it is at no cost. You can even get your option chains on here. So definitely something worth checking out. And you know, using in conjunction with your levels that you're interested in for that trading session. So, and as far as fading, you know, in a low volatility environment, if you can hit one of those levels, you know, bringing it, you know, back in, even better. But overall, I mean, just be aware that this is how the algos trade. I mean, it's very simple. The one thing that I can recommend that you can do is get your brain out of trading. Don't overthink it like I did. I spent the first 5 years trying to overanalyze everything. And I think if we can just stick to some really simple concepts, volatility is going this way, the equity indexes are going to go the opposite way. It's going to come back to the mean. Where is that mean? And if I don't know where that is off of just the high lows for the volatility spikes, just put a Donchian channel on it and look for the mid-band. I mean, keep it simple. And I think you'll find that that improves your trading. And then just get used to whether the volatility or the range is expanding or contracting, and how that applies to price. Now, you put this on crude or something, that range contraction, you're pretty much going to see, price turn around and go the opposite direction. But in the equity indexes, you get that drift up in the longs. But you just have to get used to the way that the markets work, and then work with the market and don't work against it. So that's all I have for you guys. Thank you so much. I appreciate it. Hope you have a good rest of your week, and hope this information helps you so much. Keith, I'll hand it back to you. Thank you so much, Guy.
Great. Thanks, Julie. Yeah, seeing a lot of good feedback. Someone says very knowledgeable and useful. Thank you. Thanks for the presentation. Very refreshingly different way of looking at the market. Thanks. So,
Good, good,
yeah,
good, good.
very, very nice feedback. Yeah, if that's everything from you, if you covered all the questions, I think I'm happy. Yeah,
Thank you guys
that's
so
great.
much. Yeah, appreciate your time.
As for the rest of Shark Week, as you guys know, we've got another scheduled talk this afternoon with Rob Mitchell with Axiom Research and Indicator Smart, trading dynamic zones for high win percentages. So coming back if you're interested in that topic, 4:30 Eastern time. Got 2 more tomorrow, and then our final talk on Bloodhound on Friday from yours truly, or not me, but Shark Indicators. Thanks, guys. See you this afternoon.